In our previous lesson, we discussed various factors affecting exchange rates. In this lesson, we will discuss how monetary policy affects exchange rates, while we will also discuss what inflation is and how it affects monetary policy. But first of all, what is monetary policy? Monetary policy is the action taken by a country's monetary authority, usually a central bank, and usually has an effect on the supply of money in an economy. Central banks control short-term interest rates in order to support the economy, and particularly to control inflation. What is inflation? Inflation is the rate at which the general level of prices for goods and services is rising. It is typically measured as an annual percentage change, for example 5% year on year. However, it can also be expressed in terms of a month-on-month basis or even a quarter-on-quarter basis. You can also view it in a reverse mode by considering the loss of purchasing power of each unit of currency at each year. For example, if inflation is 5% annually, then theoretically a pen that costs €1 in year 0, so for example 2021, will cost €1.05 in year +1, for example 2022. That means that one unit of currency, say for example the euro, will buy you less things in year 2022 compared to year 2021. This is why you may have heard your parents or grandparents say things were so much cheaper in our time. It's true, things were a lot cheaper. That pen may have cost only 5 cents in 1950, for example. However, salaries were much lower as well. Moving now to the costs of high inflation. It should be noted that in the economic scene, inflation tends to have a different impact on various groups of people and social groups in very different ways. In general, high inflation hurts savers. If you have €100,000 in the bank and inflation unexpectedly spikes to 10%, your money now buys roughly 10% fewer things. But it helps borrowers. Imagine you just got a loan of €100,000 to buy a house worth as much. Should inflation the following year rise to 10%, the same house will have a value of €110,000, but you will still owe only €100,000. The biggest threat to the economy, however, may be when inflation moves sharply and unpredictably from year to year, for example 1% in 2021 and then 10% in 2022. The uncertainty over what happens next makes consumers less likely to spend as their real income may fall, corporations may be more hesitant to invest, and so on. To understand why it's so important, it's useful to examine its extreme forms: very high inflation, hyperinflation, or negative inflation, deflation. Hyperinflation is practically when prices are rising so rapidly that money becomes practically worthless. One of the worst instances of hyperinflation was recorded in Zimbabwe. In 2008, inflation was estimated at 231 million% year on year. That means that an item that cost $1 Zimbabwean in 2007 was worth 231 million the following year. It's understandable that any efforts in planning any business investment, savings at the bank, or even your own personal expenditure in such an environment becomes practically obsolete. The opposite to inflation is called deflation. It's a decrease in average prices. Should prices of items continue to fall in a constant manner, market participants will be disincentivized to actually proceed with purchases. Why buy the car you want today when you can buy it next year for 1% less? But if everyone thinks like that, demand in the economy collapses and we enter recession. Companies close down, people lose their jobs, etc., etc. Now, the role of the central banks is practically to focus on controlling inflation. Most central banks have a mandate, which is usually to keep inflation low and steady, usually close to 2% per year. Given that there is a cutoff point, two scenarios come to mind. The first scenario, when inflation falls below 2% target, central banks usually lower interest rates in order to boost inflation. In the second scenario, when inflation, say for example, is above 2%, central banks tend to raise rates in order to bring inflation back down. Yet the question is, why and how do economic mechanics work in these scenarios? Scenario 1, inflation below target. The central bank lowers rates to stimulate borrowing. Higher borrowing means more economic activity, which usually leads to higher demand and has higher prices overall. So we have lower rates, higher borrowing, increase in economic activity, higher demand, higher prices. In the second scenario, say for example inflation is above target, the central bank raises rates to curb high inflation. Higher rates, then we have lower borrowing, a slowdown in economic activity, lower demand, and slowing prices. Interest rates and exchange rates. Raising interest rates usually causes a currency to strengthen. Reducing rates usually leads to a weakening of the currency. You can think of these reactions in the context of how much you get to save your money at the bank. If Australia suddenly raises interest rates, it becomes a more attractive place for international investors to save their money in. But to save your money in Australia, you have to exchange your local currency, for example the euro, for Australian dollars. This leads to more demand for the Aussie and thus the currency strengthens. Conversely, if Australia cuts rates, it becomes less attractive. This leads to less demand for the Aussie and thus the currency weakens. So why do some central banks look at exchange rates? How strong or weak a currency is has implications for inflation. Hence, central banks, one way or the other, closely monitor the exchange rates of the currency. A weaker currency could imply that the country's exports are to be more competitive in the international trading arena, i.e. they cost less for customers using a currency stronger than your own. But on the flip side, it would also imply that imports of goods and services in your country become more expensive, hence pushing retail prices higher, thus causing higher inflation. Thus, if you are a central bank trying to raise inflation, say from 1% to your 2% target, a weaker currency can help you. On the other hand, a stronger currency brings the price of imports down, which may hold over inflation in your economy down as well. In some extreme cases, the central bank has to step into the market in order to balance the supply and demand for its currency. In case the currency is weaker than desired, it will buy its own currency. That would mean practically selling its foreign reserves. There's a limit to how much it can sell because eventually they run out of reserves. If the currency is stronger than desired, they just print money and use it to buy foreign currencies. For example, the People's Bank of China, the Swiss National Banks, and others. So overall in the current lesson we saw the mission of a central bank and how monetary policy affects exchange rates, while we also discussed the importance of inflation. In the next lesson we will take a look into fiscal policy and how it blends in with monetary policy.